I think most people know how to do this, hopefully. Um, but how to compute interest, okay? Uh, some examples. Okay, I guess the formula is you take the principal outstanding times the interest rate times the amount of time. Okay, so this can all, it's really the time is going to be the variable, like the unit is going to vary. Okay, so in this case, we have $1,000 loan. How much is 1 year of interest? 6% interest rate. This is easy. It's this principal times 6% times 1 year, because this is the yearly interest rate, is $60. In this next example, $2,000 loan, 9 months of interest, months. Okay, so this is the key unit is months. 10% again is the annual interest rate. So if you wanted to figure out what the amount of interest is, you have to do some fraction. Okay, hopefully this is not mind-bending mathematics. It shouldn't be. Principal amount times the rate times, and again, this is a yearly rate, so you need to have the fraction of a year. So 9 months over 12 is going to give you 3/4, right? So you're only going to calculate interest for 3/4 of a year, and you get $150. Okay. Now, what about this? This is now the next, this one requires maybe a little bit change in uh, strategy. Okay, so you have a $5,000 loan. Now we're going into days. Okay, 65 days of interest, but the rate is still quoted in years, like a yearly rate. Okay, so one way to do it is to keep your rate as a year and then figure out what fraction of a year 65 days is. You could convert this into a daily rate by doing 0.12 divided by 365, and then this times 65 days. Okay, so it's up to you. But basically what you have to do is make sure that your interest rate and your time period are in the same units. So if this is a yearly interest rate, this time period has to be in years. In this case, it's a fraction of a year. There's an easy way to calculate the number of days between two dates in Excel. All you have to do is subtract them from each other. Okay, so for example, if we had 1/5/2025, and let's say 5/15/1999, okay, so two random days, I could just do one minus the other, and it tells me exactly how many days are between those two. Okay, so this will be useful when you're given a payment date for a loan and the origination date, and you're calculating how much interest has accrued. Okay, because you'll just have to subtract two dates from each other. Okay, in the real world, you don't use this months thing. Everything is in days. But when you're dealing with hundreds of millions or billions of dollars, each day matters. So it's like really the day counts will be, it'll factor in the day counts. And even the method of how you count a year, there's like different, like there's some day count method that's assumes 360 days in a year, and each month is exactly 30. There's one called actual over 360, which is the actual day count over a 360-year day. And then there's actual over actual. So there's different even ways of how you divide up the months and the days in a year. Okay, so because each day does matter, like that, those little differences will translate to real money when you're dealing with large sums. So in the real world, it's a little more complicated, but we're just keeping it for right now relatively simple. So yeah, just make sure that you use this Excel trick. I think it's going to make your life a lot easier if you can easily figure out how many days are between two dates. Okay? Okay, so um, and I think we've seen some of this already when we were doing chapter 3 with the accrual of interest. But just to review, um, in this situation, we made a loan of $1,000 on this September date, September 30th, so it's the end of the month. It's a 1-year loan. Interest rate is 6%. And at the end of December, at the end of our accounting period, we want to accrue interest, okay, as an adjusting entry. We want to make sure that our 2025 financial statement includes the correct amount of interest revenue, right? Because we're, again, the lender. So just to review the accounting entries, the journal entries, when we originate the loan, we have a note receivable. We're lending cash. To figure out how much interest is from here to here, the calculation is right here, $1,000 times the interest rate, 6%. And we have end of September, so October, November, December, 3 full months of interest, which is where we get this 3 out of 12, 12 months in a year. And so we get $15. That's how we know how much interest to accrue, is by doing this interest calculation. We then do our adjusting entry, right? Interest receivable, because again, the payment is only once in a year. It's going to happen after a year, but we're going to until then have this receivable, and we're going to record this revenue. That's the whole point of the adjusting entry, is to make sure that $15 of this revenue is included in my income statement. Okay, so now when the payment happens, we're going to have the rest of the interest from here, from the end of the year to the payment date, is just the rest of the 9 months of the year. Because remember, 3 of it got included in this last period. 9 months is included in the next year. And then when they pay us, they're going to pay off the principal. They're going to pay off this receivable that we recorded. And we're going to also have this revenue for recorded in this 2026 year. So now in 2026, in the income statement, we're going to have $45 of interest, which is correct, right? In last year, in 2025, we would have shown the $15, which is also correct. So this is a little, I'm going to ask you to do, like, now the day count stuff is a little weird, not typical. You have to use Excel for this. So on November 19th, so random day, this company makes a sale and accepts a 60-day note. It's a $5,000 note receivable. Just do the journal entry. It's okay, so it's a little weird. Okay, what we're doing here is we're converting an account receivable. So this is basically what happened, is that the company, this customer of ours, had an account receivable. They're like, I can't pay you right now. So what we're doing is we're converting that account receivable to a note receivable. Okay, so that's part of this journal entry. And it's now 60 days. Okay, so there will be one that happens. There's one journal entry that happens here where we convert the account receivable to a note receivable. We'll do an adjusting entry based on now this note receivable has a stated interest rate, and there's been some amount of time that's passed from here to here. So you have to do a journal entry here for calculating that interest. And then when you pay it off, there'll be another one here. Okay, so see if you can figure that out. And really, I think the difficulty will be in doing the interest calculation. And maybe this first one, converting an account receivable to a notes receivable. It shouldn't be, because I'm telling you what you have to do in words. But yeah, try to do this on your own. We'll take a couple of minutes and see if you can do that. Okay, so the first one, this first journal entry, we're just going to do, we're getting rid of an account receivable and we're receiving a note receivable. Okay, so it's basically note receivable 5,000 debit, and we're reducing accounts receivable by 5,000. Okay, so now this customer, they no longer, we've just traded terms basically. Like one is accounts receivable is short term, we're now making it a long term loan. Okay, now how do we calculate the interest from the time that happens to the end of the year? Well, can just go here. So I have these two dates. I just subtract one from the other. It's 42 days. Okay. And then it's a 12% interest rate, and the principal balance is 5,000. Interest rate. And then principal. Okay. So I have all the parameters that I need. Okay. So if I want to figure out how much interest to accrue, I will just do principal balance times the rate, which is a yearly rate, times the number of days divided by 365. So 42 divided by 365 is the fraction of the year that I'm calculating interest for. So $69.04. Okay, so then I have my journal entry. So I have here, the journal entry will be interest receivable, $69.04, and we'll have interest revenue credited. Okay, so then when they pay us off, so we had 42 days here. How many days are going to be in the next year? This is kind of like not drawn to scale, because 42 is like the majority of the 60 days. So how many days are here? 18, exactly. Okay. So total interest, I guess the total interest paid is going to be basically principal times this interest rate times 60 divided by 365. Okay, so this is the total interest that they're going to pay plus the principal of 5,000. So we know that it's going to be basically cash. It's going to be $5,098.63. Okay, I would start with that. That's like the most obvious part of it. How much cash they're going to give us total. Principal plus total interest of 60 days. That's how much I'm going to debit because that's cash I'm receiving. Now, what goes away? The obvious part is notes payable, or sorry, notes receivable. That's going to be 5,000 credit. They're paying us off. We had that as an asset. Now they're going to kind of pay that balance off, and we no longer have that asset. And now it's like the little tricky thing because we have that interest receivable from the adjusting entry. So we see that this interest receivable was $69.04. And then the interest revenue for those 18 days, right, of the next year, some of the interest, some of this $98 is of course revenue for the next year. So you could just either, we could go back to this Excel sheet and just do a calculation like this: 5,000 plus 12 times 18 divided by 365. But really, it should also be this plus this should be $98.63. So it is. Okay, so we could have also just done it a different way by taking the total minus what we accrued. It will give us the same result. Okay, so $29.59. $29.59. Okay, so this would be our journal entry for this payment.